I want to start today with a question. A single, seemingly simple question that I've been chewing on all morning. Which is the most important app on your smartphone? And it doesn't matter if you're on an iPhone or an Android. Which app is the actual, king of your digital life?
I feel like this is a trap.
Yeah.
You know, when I say something like my web browser or my messages app.
The obvious ones.
But knowing you, it's probably something way more obscure. The answer has to be the one we spend the most time on, right? Instagram, TikTok. Or maybe the utility stuff, like email, which, runs our work lives.
You would think so. I actually looked at my screen time stats, and yeah, social media wins on raw minutes, for sure.
Of course.
But in terms of importance, in terms of, survival, no. It is not Instagram or X or Uber. It is your bank, or maybe Coinbase, or the likes of Cash App, PayPal, Venmo.
The wallet.
Oh.
The economic energy, that makes a lot of sense.
Right.
If that app stops working, the rest of the apps don't really matter because you can't pay for the data plan to even use them.
Exactly. The app that holds your economic life force is the most vital, yet, and be honest here, it's often the most antiquated, clunky, and frankly just boring app on your phone.
Oh, it's the worst.
I dread opening my banking app. It feels like I'm stepping back into 2005 every single time. But that is about to change, or rather, if the research we're looking at today is correct, it's already changing in ways most people haven't noticed yet.
It absolutely is. And, in our previous discussions, we've touched upon the evolving landscape of global finance and technological competition. We've looked at the macro picture, central banks, geopolitics, that kind of thing.
The 30,000-foot view.
Exactly. But today, we are going to zoom all the way in. We're delving into how these paradigm shifts of distributed blockchain solutions impact the common man. The person who is completely oblivious to the underlying architecture.
The person who doesn't care about Bitcoin versus Ethereum.
Or stablecoins versus digital credit. No. They just want their money to work.
Yeah, right, because most people don't care about the plumbing. They just want hot water when they turn the tap. They want the app to open fast and their money to be there.
Precisely. And that's what we're talking about today. We're talking about a state of financial existence that our research sources are calling Banking Nirvana.
Banking Nirvana? I like the sound of that, but I'm skeptical. Nirvana implies a state of peace, right? Enlightenment.
It does.
In banking, I usually associate peace with low returns. Usually if I'm at peace, it means my money is safe, but it's earning absolutely nothing. So is this Nirvana spiritual or is it profitable?
It's definitely profitable. It means a state where liquidity, so having access to your cash instantly, and yield making significant money on that cash can coexist. It's about breaking the trade-off that we've all been forced to make for, 50 years?
Okay, let's unpack this, because usually if I want any kind of high interest, I have to lock my money away. I have to buy a CD or a bond or put it in a savings account that I can't touch without some penalty.
Right, it's illiquid.
And if I want to spend it, it has to be in my checking account earning a glorious 0%. You're saying that fundamental rule is breaking.
It's already broken. The technology to break it exists. We just need to distribute the solution to everyone. It's about merging the spending power of a checking account with the earning power of a, high-risk asset class, but smoothed out so the average user doesn't feel the volatility.
All right.
Welcome to the Deep Dive. I'm Satosha.
And I'm Satoshi. Before we get into the how, and I have a lot of questions about the how because it sounds a little bit too good to be true, I have a very specific request for you, the listener. First of all, thank you very much for the amazing response. The objective of the show, as you know, is to check if there's space for really deep academic research on topics that matter to normal people. And your support is living proof that popular media desperately needs content beyond pure clickbait. It is not really how it is spoken. It is all about if the research is coherent, meaningful, and timely. That said, the only measure of acceptance is if you subscribe. And here is the fact from our analytics team. Only 1.99% of our listeners subscribe to the show. And here is our problem. We need a hard 1,000 count to keep the show alive. So please hit that subscribe or follow button wherever you reach us. YouTube Music, Apple, Spotify, or Fountain.fm. If you listen on another platform, please drop us a note in the email and description so that we are able to count you towards our goal.
It really does make a huge difference. The algorithms are, they're brutal. And that direct support is what helps us keep the lights on and the research flowing.
Absolutely.
And just to remind you of our process, as you know, we are a research-first show. We first publish a paper or an essay or a blog at the deep dive website that is linked in the description, and then get to the audio part. So please do check out the email and research in the description.
Okay. Housekeeping done. Let's get into the meat of this. Banking Nirvana. I want you to paint me a picture. I'm imagining an app. What does this Nirvana app actually look like when I open it? Is it complex? Do I need to be a trader to understand it?
No, not at all. Visualizing the interface is the best place to start. So imagine opening an app on your phone. It looks cleaner than your current bank app. Much cleaner.
That's a low bar.
It is a very low bar. Think minimalist. White background, bold black text. Very Apple-esque. But structurally, it's what we might call the mullet design of fintech.
The mullet design, you mean?
Yeah.
Like the haircut. Business in the front, party in the back.
Exactly. And I use that term affectionately. Business in the front means a dead simple interface for you, the user. You don't see charts. You don't see order books. You definitely don't see things like gas fees.
Thank God.
But the party in the back is a complex, high-performance engine running on crypto rails and securities laws that you never have to see. When you open this app, you see two distinct tabs, two tiers. That's it.
Okay, walk me through them. Just two tabs. That sounds simple enough.
Just two. Tab 1 is Spend. This is Tier 1. It is the replacement for your checking account. Tab 2 is Save. This is Tier 2. It represents the replacement for your savings account.
Okay, that sounds exactly like my current bank app. I have checking and savings. Chase has been doing that for decades. How is this a revolution?
It looks the same, but the engine underneath is completely different. In the Nirvana model, you, the user, you don't need to know that you're trading stocks or using blockchain.
You're just using your money.
You just see your money growing faster. Much, much faster, and moving instantly. The promise is a seamless experience where all the friction of the old world is just.
Yeah.
It's deleted.
So why do we need this redesign? Let's talk about the problem more. What is so fundamentally wrong with the status quo? I mean, my checking account works. I swipe my card. Things get paid. I feel like we take that for granted. Why are we trying to fix what isn't broken?
It works, but it's incredibly inefficient. And you're paying for that inefficiency, even if you don't see the bill. Let's look at the spend side first, or the checking account. In the industry, they call the money that sits in there lazy capital.
Lazy capital? That sounds so judgmental. My capital works hard. I earned it.
You earned it. But the moment it sits in that checking account, it retires. Yeah. It puts its feet up. It earns 0%. But even worse than that, it suffers from what's called pre-funding friction.
Pre-funding friction?
Yeah. Because of the legacy banking system, which, and I'm not joking, runs on COBOL mainframes from the 1970s.
Yeah.
Money doesn't move on weekends or holidays.
Oh, right. 3 to 5 business days. The phrase we all love to hate.
The absolute worst.
I actually had this happen recently. I transferred money on a Friday afternoon to pay a contractor, and they didn't get it until Tuesday morning. It was incredibly embarrassing.
And that is the lazy capital problem in a nutshell. Because you don't know exactly when a charge will clear or when a deposit will actually land, you have to keep extra cash in that 0% account just to be safe.
A buffer.
It's a buffer that is doing nothing for you. It's just sitting there as a protection against the banking system's own incompetence and slowness.
So I'm effectively paying an opportunity cost just to avoid overdraft fees because my bank is slow. That's infuriating.
Exactly. Now, let's look at the safe side, the savings account. You'd probably have a high-yield savings account, right? An HYSA?
I do. I'm getting, I think, 4.5% right now, maybe 5% on a good day. It feels pretty good compared to the 0.01% I used to get.
Right, it feels good. But we call that ineffective capital. And here is where it gets really interesting and honestly a little painful. I want to walk you through what the research calls the math of erosion.
Erosion? That sounds ominous, like my money is washing away.
It is. So you have a 5% nominal yield. On paper, you made $5 on every $100. Sounds great. But you are likely in a high tax bracket if you're listening to this deep dive.
Let's assume.
Between federal and state taxes, the government is going to take about 40% of that interest income. It's taxed as ordinary income. So that 5% yield is actually, what, 3% after tax?
Okay, I'm down to 3%. Still positive, though. Better than nothing.
Now, you factor in inflation. Let's say the official CPI, the Consumer Price Index, is running at 3%. And we both know real inflation for things you actually buy is probably closer to 4% or 5%.
3% minus 3% is 0.
0% real return. You are not making money. You are just treading water. You are preserving purchasing power, but just barely.
Wow.
And that's the best case scenario with a high yield account.
Yeah.
Most people at the big banks are getting 0.01%, which means they're actively losing purchasing power every single day.
That is depressing. When you put it that way, we are essentially just unsecured creditors to the bank. Is that the right term?
Yes. That is the legal reality. You lend the bank your money for free or for a tiny fee. They turn around and lend it out for mortgages at 7% or credit cards at 25%. They keep that massive spread. You get the crumbs.
And the goal of the Nirvana architecture is to let me keep the spread.
To move from this bifurcated, inefficient model to a hybrid architecture where you reclaim that value.
Okay, I'm sold on the why. The current system is slow, it's inefficient, and it silently eats my wealth. Let's talk about the how. You mentioned Tier 1 and Tier 2. Let's start with Tier 1, the speed layer. You said this replaces the checking account.
Yes. So in this new model, we redefine the checking account entirely. The asset you hold is not a deposit at a bank branch. It's a stablecoin-like USDC or USDT pegged one-to-one with the local currency, in this case, the US dollar.
So instead of a number in a bank's private database, I'm holding a digital token on a public blockchain.
Correct. The entire infrastructure shifts. It moves from private bank ledgers and those COBOL mainframes to public blockchains like Solana, Ethereum, or Base.
Okay, hold on. Public blockchain. That word public makes me nervous. If I lose my phone or if I get hacked, is my money just gone? Because with my bank, I can call them and they can reverse a fraudulent charge?
That's a totally valid fear, and it's what held this back for years. But remember the mullet design.
Business in the front.
Business in the front. The front end is the app company, the Fintech. They are the ones managing the keys in a secure way. To you, it feels like a login with Face ID. If you lose your phone, you recover your account through customer support, just like a bank.
Okay, so it's a custodial setup.
Exactly. But on the back end, the money is moving on these public rails. And this fundamental shift gives your money what we can only describe as superpowers.
I love superpowers. What does my money get to do now that it couldn't do before?
The first superpower is velocity. We call it atomic settlement. Compare this to the automated clearinghouse, or ACH, which drives the current banking system. ACH is batch processing. It literally collects transactions in a bucket all day and then processes that bucket at night.
Right. It's the check is in the mail logic of the digital age. It's physically moving batches of data from one place to another slowly.
Exactly. Now look at a network like Solana. Block times are approximately 400 milliseconds.
400 milliseconds. That is literally faster than the blink of an eye.
And it allows for things like streaming money. Imagine real-time income and expenses. Imagine getting paid every second you work. You finish an hour of work, and that money is in your wallet. Not in 2 weeks after payroll runs. Instantly.
That would change everything for people living paycheck to paycheck, or for any business trying to manage cash flow. The float is gone.
It is. The second superpower is availability. The blockchain is a 24/7, 365 network. There are no bank holidays. The blockchain doesn't take Martin Luther King Day off.
Doesn't close at 5 p.m. on a Friday.
Never. If you need to pay a vendor in Singapore on a Sunday afternoon, it happens instantly.
That anxiety of funds will be available on Tuesday is just gone.
Yeah. Gone. And the third superpower is interoperability. Currently, money in a Chase account is trapped in a Chase silo. Moving it to Robinhood takes days and an act of Congress.
It feels that way.
Stablecoins are bearer assets. They move between apps and wallets as freely and easily as sending an email.
But wait a minute, this all sounds great for the digital world. I can send money to my friend in London instantly. Awesome. But I can't buy groceries with USDC yet. I can't pay my rent with a crypto token. My landlord wants a check or a wire transfer.
That is the bridge problem, the last mile. And it is being solved as we speak by the biggest players in the game, Visa and MasterCard.
Really? The old guard? I thought crypto was supposed to kill Visa and MasterCard.
Not kill them, upgrade them. They see the writing on the wall. Late in 2025, Visa launched a massive pilot on Solana. They are now allowing their issuer and acquirer partners to settle transaction obligations directly in USDC.
So explain that. Why does Visa care? What's in it for them?
Efficiency and cost. Massive cost savings. Before this, let's trace the money when you swipe, say, a crypto-linked card. The company had to sell your crypto, convert it to fiat currency, wire that fiat to a bank, wait for the wire to clear, and then pay Visa.
That sounds like a lot of steps and a lot of waiting.
It was a process that took days. And that meant the card issuer had to keep millions of dollars in pre-funding accounts just sitting there to cover the gap between your swipe and their payment to Visa.
Lazy capital again, just giant piles of cash doing nothing but acting as a buffer for a slow system.
Exactly. Visa's pilot proved that using USDC on Solana reduced that settlement latency from 8 days down to 4 days initially, and now it's effectively down to seconds. It also cut their foreign exchange fees by 20 to 30 basis points. That's huge at their scale.
So the plumbing is already being upgraded by the incumbents themselves.
It is. And MasterCard is doing the same thing with Circle for USDC and URC in Europe and the Middle East. The payment rails are legitimizing Tier 1 as a valid checking vehicle. You swipe your card, the merchant gets paid in dollars, but on the back end, it's all settling with instantaneous stablecoins.
Okay, so Tier 1 is speed, it's velocity, it's making my checking account instantaneous and global. I get that. But you said stablecoins don't pay interest. In fact, under the new laws, which we'll get to, they can't pay interest.
Correct.
So where is the nirvana? Where is the yield? If I move all my money to USDC, I'm still just treading water, losing to inflation.
That brings us to Tier 2, the wealth layer. This is where we redefine the savings account. And this is where the skeptical alarm bells in your head should start ringing and ringing loudly.
They are ringing. You promised me high yield and high liquidity. Usually when someone promises that, it's a Ponzi scheme.
It's not a Ponzi, but it is some pretty sophisticated financial engineering. We are not talking about buying Dogecoin or speculating on the price of Ethereum here. We are talking about specific instruments, perpetual preferred equity.
Okay, that sounds like Wall Street speak. Perpetual preferred equity. Break that down for me like I'm 5.
The specific instruments mentioned in the research are STRC, that's Strategy Inc., Preferred, and SATA, which is Strive Preferred. The key thing to remember is these are SEC-registered securities trading on the NASDAQ.
Okay, so they are stocks. They are not crypto.
They are stocks that trade on the stock market, like Apple or Google. But their behavior is engineered to act like a savings vehicle.
How is a stock a savings account? Stocks go up and down. If I put my life savings in Tesla, I might be up 20% or down 20% in a single week. Savings accounts are supposed to be stable. Boring, even.
That is the genius of the engineering. These companies, Strategy Inc. and Strive, are what we call Bitcoin treasury companies. Their primary business model is raising capital to acquire Bitcoin.
So they are basically just hoarding Bitcoin, like Michael Saylor and MicroStrategy did back in the day.
Effectively, yes. They are creating what they call a Bitcoin flywheel. But for the holder of the preferred stock, which is what we are buying for our Tier 2 savings, they are stripping away the volatility.
How do you strip away volatility from Bitcoin? It's arguably the most volatile major asset on Earth. It swings 10% on a single rumor.
You use a very clever mechanism called thermostatic dividend control.
Thermostatic control, like an air conditioner for the stock price. That's what I'm picturing.
That's a perfect analogy. Let's walk through the mechanics. The par value of the stock is usually fixed at, say, $100 or sometimes $25. The company publicly commits to using its tools to keep the price near that par value.
Okay, so they want it to stay at $100.
Right. Now, imagine a crypto winter hits. Bitcoin crashes, the market gets scared, people start selling STRC, the price drops to $98.
Okay, so I'm losing money. This isn't a good savings account.
But the thermostat kicks in. The dividend rate is algorithmically linked to the stock price. If the trading price drops below $100, the dividend rate automatically increases.
Ah, so the yield goes up. It becomes more attractive.
Significantly. If the price drops a few percent, the yield might jump from 11% to 12% or 13% or even 14%. Now, you're an investor in the market. You see a stock trading at a discount at $98 that pays a 14% yield and is backed by a massive treasury of assets. What do?
I buy it. That's a steal. It's like a bond on sale.
Exactly. Yield-hungry buyers swoop in, that buying pressure increases, and the price is pushed back up towards $100.
And if it goes above $100, say to 102 or?
The thermostat cools it down, the dividend rate automatically decreases. If it goes to $102, the yield might drop to maybe 9% or 8%. At that point, sellers step in to take profits, the selling pressure brings the price back down, and it stabilizes. The result is a stable price, largely decoupled from the day-to-day swings of Bitcoin, but offering a massive, massive yield.
What kind of yield are we talking about here? Be specific. What do the sources say?
As of the 2026 market landscape, described in our source material, Strategy Inc., STRC, is paying an 11.25% annualized yield, and it's paid monthly. Strive, SATA, is paying 12.25%.
12.25%. That is double, almost triple what a high-yield savings account pays. That sounds insane.
It is high. It's game changer.
But wait, here is the elephant in the room. Strategy Inc. is backed by Bitcoin. What happens in a real crypto winter? I'm talking a deep freeze. If Bitcoin crashes by 50% or 70%, How can they possibly pay me 11% dividends? If the underlying asset collapses, the thermostat breaks, right? The whole thing spirals to zero.
That is the most important question. That is the death spiral risk that everyone worries about, and the issuers know it. That is why Strategy Inc., for example, established a $2.25 billion USD reserve.
2.25 billion in real cash, not crypto.
Real cash, fiat currency, it's ring-fenced. It is held completely separate from their crypto operations, and that cash reserve is large enough to cover 2.5 years of dividend payments at the current rate.
So even if Bitcoin goes to zero, or at least freezes in a bear market for 2 whole years, they can keep paying the yield from this cash pile.
Exactly. It buffers against the crypto cycle. It's the shock absorber. It turns a volatile asset into a stable income stream for you, the Tier 2 holder. They have essentially over-collateralized the yield to ensure confidence and stability.
Okay, so we have speed and global access in Tier 1 and massive stable yield in Tier 2. But you mentioned something earlier about tax alpha. You said the returns were even better than they looked on paper. This sounds like it's getting into a gray area. Is this legal?
It's not a gray area at all. It's not evasion. It's avoidance. It's using the tax code exactly as it is written. This is the fiscal engine of Banking Nirvana. This is how the rich get richer, and now it's being packaged for regular people.
I am all ears. How do I legally pay less tax on my savings?
To understand this, we need to distinguish between two types of income in the eyes of the IRS: ordinary income and return of capital.
Okay. Bank interest is ordinary income, right?
Yes. If you earn $100 in interest from your Chase savings account, the IRS treats it just like your salary. It is taxed immediately in the year you receive it at your highest marginal rate. In a state like California or New York, that could be 45% or even 50%.
Ouch. So my 5% yield is really 2.5% after the government takes its cut?
Exactly. But the distributions from these digital credit instruments are different. Because these Bitcoin treasury companies invest so aggressively and they have high depreciation, paper losses on their Bitcoin mining equipment or just the accounting structure of their investments, they often have zero earnings and profits, or E&P, in the eyes of the IRS.
So they are technically losing money on paper, even if they're profitable in reality.
Correct. And under U.S. tax law, if a company with no accumulated E&P pays a dividend, it is legally classified as a return of capital, or ROC.
Return of capital. What does that actually mean for me, the saver?
It means the distribution is not taxed when you receive it.
Wait, zero tax. I get the check for my monthly dividend and I pay nothing to the IRS on it.
Zero tax today. Instead of paying tax, the distribution amount is used to lower your cost basis.
Okay, example time. Make this concrete. My brain hurts with tax accounting.
No problem. Let's say you buy one share of this TRC for $100. You hold it for a year, and you get $12 in distributions paid out to you. You pay zero tax on that $12 when it hits your account. But the IRS says, okay, you've effectively only paid $88 for that stock now. Your cost basis is reduced from $100 down to $88.
Okay, so I'm kicking the tax can down the road. Eventually, I have to pay the piper.
You are. But that deferral is incredibly powerful. You only pay taxes when you eventually sell the stock, which would be years, even decades later. And when you do sell, you pay tax at the long-term capital gains rate.
Which is much lower, right?
Much lower. It's usually somewhere between 0% and 20%, depending on your income. That's a huge difference from the 37–45% ordinary income rate. You are essentially doing rate arbitrage. You are converting high-tax income into low-tax growth.
Let's look at the numbers. Because compounding tax-free has to be a huge advantage.
It's massive. Let's run a comparison over a 10-year timeline. You start with $100,000. Scenario A. You put it in a high-yield savings account earning 5%, and you're paying taxes on that interest every single year. Scenario B. You put in a digital credit instrument earning 12%, and the tax is deferred until the very end.
Okay, hit me with the totals after a decade.
In the high-yield savings account, after 10 years, you have $134,392. So you made about $34,000. Not bad.
Okay, decent growth. Kept up with inflation, maybe a little more.
In the digital credit account, even after you sell everything and pay the capital gains tax at the very end, you walk away with $268,468.
Whoa, that's almost exactly double.
It is double the wealth. That is tax alpha.
Yeah.
That is why 12% in this structure is worth far, far more than 12% in a bank. It's the difference between linear growth, which is dragged down by taxes every year, and true, unhindered exponential growth.
This sounds incredible, but it also sounds complicated to manage. I don't want to be a day trader. I don't want to log in every morning and say, okay, time to buy some STRCs, sell some USDC. I just want to live my life.
And that is section 5 of our deep dive, the mechanics. The liquidity bridge. The user shouldn't do any of this manually. It all has to be automated.
Completely automated. If I have to think about it, I won't do it. And most people won't.
The core concept is the smart sweep.
Yeah.
You just set one simple rule in the app. For example, you say, keep $2,000 in my spend account, tier 1, at all times.
Okay, like a floor.
Exactly, a floor for your daily spending. Then your paycheck hits via direct deposit. It instantly converts to USDC. The app sees you now have, say, $5,000. It knows your floor is $2,000.
So it knows there's an extra $3,000 just sitting there being lazy.
And it automatically sweeps it. It triggers an API call to a brokerage partner and buys $3,000 worth of STRC. It uses fractional trading, so every single penny is invested. You don't lift a finger. Your savings are on autopilot.
Okay, that covers the savings side. That makes sense. But what about the spending side? This is the scenario that still stresses me out. I have $0 in my spend account. All my money, say $10,000, is in the wealth layer, tier 2.
Right.
I'm out at a nice dinner. I just ate $500 worth of sushi. The bill comes. I swipe my card. But stocks take a day to sell. It's called T+1 settlement. I can't wait a day to pay for my sushi. The waiter is not going to wait for my stock trade to clear.
This is the hardest engineering challenge of the whole system, the settlement mismatch. As you said, stablecoins are instant, but stocks are T+1. There are two primary solutions emerging. Solution A is the securities-based line of credit, or SBLOC.
So lending, I'm borrowing against my own money for a short time?
A very short time. The app sees you have $10,000 in STRC. You swipe your card for $500. The app instantly lends you $500 in USDC to pay the merchant on the spot. Simultaneously, in the background, it executes a sell order for $500 of your stock.
And when that stock sale settles the next business day?
The proceeds from the sale automatically pay off the microloan. It's completely seamless to you. You don't see the loan. You don't see any interest because it's basically paid off in less than 24 hours.
But isn't there a risk there? What if the stock market crashes that specific night before the trade settles?
That's the risk management the app handles.
Yeah.
They'll only lend you a certain percentage of your total holdings, a loan-to-value ratio, to create a buffer. But there's also solution B, which is simpler, the Fintech float.
What's that?
The Fintech company uses its own balance sheet. They pay the restaurant instantly with their own cash. They trust that your stock sale will clear tomorrow, and they just reimburse themselves then.
So they're fronting you the money for 24 hours.
Effectively, yes. And since stock settlement in the U.S. moved from T+2 to T+1 back in 2024, the capital required to run this kind of float became much smaller. It's now efficient enough to do at a massive scale.
So to the user, it just feels like spending money from a single account.
Exactly. You are spending your stock portfolio instantly, without ever thinking about settlement times or placing a trade.
This all sounds fantastic, but also, I don't know, a little bit like the Wild West, regulatory-wise. Is the government okay with all this? I feel like the SEC hates everything crypto-related, or at least they used to.
That brings us to the final piece of the puzzle, the regulatory moat. And it's built on two landmark pieces of legislation, the Genius and Clarity Acts.
I love the acronyms Congress comes up with. Someone spends all day in a room thinking those up.
They are catchy. But these laws really did change the world for digital finance. The Genius Act, which was passed in 2025, provides total legal certainty for Tier 1, for the stablecoins. It defines what a permitted payment stablecoin issuer is. It mandates 1.1 reserves in cash and short-term treasuries. But the most important part is Section 11.
Section 11D. Sounds like the fine print.
It's the best fine print you'll ever read. It grants stablecoin holders super priority status in the event of a bankruptcy.
Super priority. What does that mean in plain English?
It means if the issuer goes bust, like an FTX situation, or even a traditional bank failure like Silicon Valley Bank, the users, the stablecoin holders, get paid first.
First? Before who?
Before the debt holders, before the equity holders, even before the lawyers get their fees. Your assets are legally separate from the companies.
So it's actually safer than a normal bank deposit over the insurance limit?
Arguably, yes. Bank deposits are insured by the FDIC up to $250,000. If you have $2 million in a bank and it fails, you're in a lot of trouble. With a Genius-compliant stablecoin, that money is ring-fenced, and you have super priority theoretically for any amount.
That is a huge selling point, especially for high-net-worth individuals or businesses.
But the Genius Act also had a very important rule, a no-yield mandate. It says issuers cannot pay interest on these payment stablecoins.
Ah. So that explains why we need Tier 2. The government forced the separation of spending and saving.
Precisely. The government effectively said, stablecoins are for payments, like a checking account, not for savings. And this forced the market to innovate, with things like digital credit in Tier 2 to generate the yield. It created a two-tiered system by law.
And what about the Clarity Act?
That was the big one in 2026. It finally ended the turf war between the SEC and the CFTC. Do you remember how chaotic that was for years?
Yeah, the SEC was claiming everything was a security. The CFTC claimed everything was a commodity. It was a complete mess, and nobody knew the rules.
The Clarity Act fixed it. It clarified that an instrument like STRC is an SEC-regulated security, and a digital asset like Bitcoin is a CFTC-regulated commodity. But most importantly, it explicitly allows for hybrid accounts.
Meaning one app can legally hold both asset types for me.
Yes. It legalizes the mullet. It allows a registered broker-dealer to hold your stablecoins and your stocks in one single unified interface for the user. It was the final regulatory green light.
So the tech is there, the laws are there, the user demand is definitely there. The big question is, who is going to build it? Who wins this race?
That brings us to the market landscape. And it's a fascinating three-way battle. First, you have the disruptors. The obvious one is Robinhood.
Robinhood changed the game with zero-fee trading. They have the user base, millions of them.
They do. And they have that gold yield culture. Their users are already used to the idea of earning a high yield on their savings within a brokerage app, but they lack a better spending rail. They need to fully integrate stablecoins to truly replace your checking account. They're very close, but not quite there yet.
Then you have the other side, the crypto-native players like Coinbase.
Right. Coinbase has the Tier 1 rail built perfectly. They have USDC, they have their own blockchain, Base, they have a Visa debit card. It all works. But their interface is way too trader-focused.
It looks like the cockpit of a 747.
It does. It scares my mom. To win, they need to simplify. They need to hide the crypto complexity and just give users a spend and save tab.
And what about the big guys, the incumbents, Chase, Wells Fargo? Are they just going to roll over and let this happen?
The incumbents, they are stuck in the classic innovator's dilemma. Think about it from their perspective. They profit enormously from the 0.01% yield they pay on your lazy capital. That is a core part of their business model. They take your free money and lend it out for a huge profit.
If they offer a 12% yield product, they are directly attacking their own profits.
They would cannibalize their own business. It's a lose-lose for them. So they cannot lead this change. They will be the absolute last to adopt this model.
Which means they risk getting hollowed out from below.
Exactly. If you can get a 12% tax advantage yield and instant global spending in a beautifully simple app, why would you keep $50,000 sitting in a Wells Fargo account earning literal dust?
You wouldn't. The moment people realize this is possible and safe, the money moves, and it will move fast.
That is the trillion-dollar migration that our research suggests we are about to witness.
It's a complete re-architecture of the most boring but most essential utility-based part of our lives.
It fundamentally shifts banking to asset management for every single dollar in your pocket. Even the dollar you're about to spend on coffee is earning 12% until the very nanosecond you select the card.
That is banking nirvana.
That is the vision.
We have covered a massive amount of ground today, from the inefficiency of lazy capital to the incredible speed of Solana, the wealth engine of digital credit, and the regulatory breakthroughs that finally make it all legal and safe.
It's a lot to digest, for sure. But the key takeaway is simple. The technology and the legal frameworks now exist to make your money work much, much harder for you, without you having to work any harder for it.
I love that. Reflect on the future for a moment. How big is this opportunity, really? It feels like it revolutionizes the most important app on your phone. It changes the relationship we all have with our own labor and capital.
It democratizes incredibly sophisticated wealth management strategies, things that used to be reserved for the ultra-wealthy with private bankers. And it puts them in a simple app that anyone can use. It's the ultimate democratization of yield.
Before we sign off, I want to remind you one last time. This show is truly a community effort. We rely on your sources across the web to put together this research, and we want you to comment if you find us even a teeny tiny bit off base. And we always need people with sharp eyes on matters of finance, crypto, and banking to comment on our content before we publish these audio deep dives. So please reach out through email, comments, or community posts as you may like. We read them all. Until next time, stay curious.
Keep the quest on. I'm Satoshi.
And I'm Satoshi.